Joining us now in the conversation is the budget. On the budget is New York economist, New York economic professor Edward Wolff. Welcome, Edward.
Hi, thanks for having me.
The proposed budget pushes the deficit $7.2 trillion over the next decade. What is the long-term impact on the economy?
Well, I think it's going to be very inflationary. I think the economy is reaching full capacity, and I don't think there's much room for additional employment or even capital capacity. So I think we're going to see inflation ticking up.
Do you think it's a smart plan?
I think it will not be very beneficial for the economy in the long run. I think if we have inflation, then interest rates will go up, and then spending will go down, and so I think it could have a very negative impact on the economy.
Eric, are you still there? Politically, how do you think the deficit numbers will play with some of the more fiscally conservative representatives?
You know, when we look at the deficit, actually the deficit was going down during the Obama administration. So we saw it decreasing, and actually since 2016, we've seen it begin to rise a little bit, and it's actually on the uptick over the last year. And so again, when the Republicans see themselves as the party of fiscal conservatism. And so now when you're seeing budget busting numbers, and you see just the deficit on the increase, I think this is something that politically just isn't going to work. In fact, you're seeing members of the conservative House Freedom Caucus already beginning to push back in a very vocal and strident terms on these numbers. And I think we're going to continue to see that over the course of this budget as the president continues to speak it up.
Stick around, Professor, because we want to get to your thoughts on the current volatility on Wall Street and other topics. Welcome back to Arise America. U.S. business editor Andrew Schmertz is off today, but U.S. markets were open for business. U.S. stocks rose today after 2 weeks of turbulence. The Dow Jones Industrials jumped more than 409 points, or 1.69% to 24,602, following its largest one-week decline in more than 2 weeks. The S&P 500 and NASDAQ also rising around 1.5%. Shares of energy companies leading the way because oil prices are up. Professor Edward Wolff is back with us with a word of advice about the swing of Wall Street. Hello, welcome back.
Thank you. Thank you.
Okay.
Great to be here.
Thank you. The recent volatility in the market has caused anxiety for some Americans. However, you noted that the vast majority of Americans, this isn't a point of concern. What did you mean by that?
Well, actually, a little less than half of all Americans own stock. So already half of Americans are not involved in the stock market at all. And even of those who do own stock, holdings tend to be relatively small. Only about 1/4 of American households, for example, have more than $25,000 worth of stock.
So 50%, that's half of American households. That means another half have absolutely nothing invested in the stock market. How has that happened, and why is it continuing to happen?
Well, there are two reasons. First of all, Americans don't save very much money to begin with, and that can actually be traced to income that's been stagnating for almost 40 years. So they just don't have the money to invest. And secondly, most Americans would rather invest in a home than in the stock market. So that's where their money tends to go.
A staggering 84% of all stocks are owned by 10% of the wealthiest Americans. That's kind of shocking. Is that gap widening or decreasing?
Actually, it has widened over time. 2001, notable for the high-tech bubble, that figure was only 77%. So it's risen over the last decade and a half. And even before then, it was never quite so high as this. So concentration of stock ownership has been rising over time.
Now, help our viewers understand all of this. There is a distinct difference between the Dow and the economy. What exactly is that difference?
Well, you know, the Dow affects people who own stock. You know, particularly people who own a lot of stock. And so their behavior is influenced by what happens in the stock market. but most Americans, it doesn't really affect their wealth at all. So for example, a 10% decline in the stock market and the Dow Jones would reduce their average net worth by only 1%. So it's not a very big effect.
That isn't big at all, but these investing disparities are so vast. One thing that I don't quite understand, consumer confidence is very high. So what is that difference about?
Well, again, consumer confidence is more a reflection of things like whether you have a job, how much you're earning, and wages have risen a lot in the last year. So that I think is the main reason why consumer confidence is up. If your paycheck is rising, then you're more confident. And what happens in the stock market doesn't materially affect you at all.
Is that a false confidence, though? Because if your wages are rising, but you're not investing in the stock market, what exactly is the confidence about then?
Well, I think the confidence reflects itself in higher consumption. So they have more money. They're not afraid of losing their job. That's very important in terms of confidence. Not just having a job, but not being afraid of losing your job. And so they're willing to spend, and so you'll see we have seen a big bump in consumption. I think that's where the consumer confidence will show up. It's not going to show up so much in savings or buying more stock.
But in essence, that's the vicious cycle. You're confident about not losing a job, therefore you spend more and you don't save, and that cycle continues. How can Americans break that cycle?
Well, there are a number of ways. I think the main vehicle is through pension accounts, and in fact, even with regard to stock ownership, for the average American, almost 80% of the stock they own is through a retirement account, like a 401k or an IRA or something of that ilk. So that's really the best way to stimulate savings and, if you want, stock ownership. And so, companies have actually, over the last decade or so, have been cutting back on supporting 401ks, and that's been pretty detrimental both to household savings and also to stock ownership. So I think companies have to I think in the best case scenario, they should be required to provide 401ks or some similar vehicle to their employees. Mm-hmm. And that, I think, will bump up savings.
For the people who do own stock, how concerned should they be?
Well, as you just noted, the stock market has suddenly come back and was down 10% as of Thursday, I guess, and now it's back up, I guess, a quick calculation, 3 or 4%. So we've already seen a rebound in the stock market. So I think I think last week was just sort of a one-time dip, and I'm pretty confident that the stock market will come back to where it was and probably will continue its upward trend. And I'm hopeful it will, because, my retirement depends on what happens in the stock market.
Yours and many.
Yeah.
So now, in the scheme and the long history of the stock market, this is not the worst correction. I'm thinking of 1987 and the big 87 stock market crash. What were the long-term economic effects to the economy after 1987?
Well, that was a big deal. That was Black Monday back then, and I don't have the exact figure, but I think the stock market went down by 35 or 40%, and that was a real shock. And but soon thereafter, it did recover, and it actually increased after 87, 88 into the 90s. and the real economy was not affected. The '80s, the late '80s, was a period of very high economic growth and actually low inflation, and so the economy itself did pretty well.
So briefly, that was a teachable moment. Are there any safeguards in place post 1987?
Well, I think the big safeguards came in post 2007. After that rather severe stock market downturn and associated financial crisis. So as far as I can recollect, I don't think there was anything in particular that was done after the '87 crash. But we've had a whole set of new legislation, new financial rules that came into being following the financial crisis of 2007, 2008. Though it looks like some of these are now being turned back. But in any case, they I think were very important.
Thank you. We'll continue with our conversation with Professor Wolff after this break. You're watching Arise America. And we continue our conversation with Edward Wolff, economics professor at New York University. In addition to his thoughts on Wall Street, he recently published a study on income inequality. Welcome back.
Thank you.
In your most recent research, you noted most households have less than $5,000 in savings. This undoubtedly puts families at risk in the event of emergencies. What should families do to prevent, or bolster their savings?
Well, I think I think the main factor is what's happening to their wages and their incomes, and we've had a long period of stagnant incomes in this country going back 15 or 20 years until quite recently, until the last year or two, where incomes and wages have been picking up. So I think, if you want to bolster savings, the best way of doing that is through rising wages, and I think this may actually be turning around as we speak, as families start to see bigger paychecks. They're going to increase their consumption, of course, but I think they'll also start to put money away in their savings accounts.
What's been the cause of this long-term stagnation as it relates to wages?
Well, I think it's more a sort of a political economy story where corporations, particularly because of globalization, have felt the need to cut costs or keep costs low, and so I think there's been a pervasive tendency to maintain wages and not increase them, and in some cases even to cut wages. And I think it's mainly because of international competition in this country.
Will minimum wages do anything to help, stem the tide in terms of that stagnation? Or
Absolutely.
Increase of the minimum wage?
Yeah, no, absolutely. I think again, from a policy point of view, I think that's a very effective weapon. And if we can get the minimum wage up, well, hopefully to $15 an hour, you'll see a big boost in family incomes, and this will translate, I think, into greater savings by families. So
what's the resistance in terms of raising the minimum wage in some states? A lot of lawmakers are very resistant to that idea. Why do you think that is?
Well, again, I think corporations, particularly those who are involved in the international arena, feel a lot of competitive pressure on them, and therefore they're very reluctant to raise wages, particularly of their lower skilled and mid-skilled workers, and so they put pressure on their local governments and their state governments not to increase the minimum wage. I think it's really counterproductive. In fact, raising minimum wages, a lot of studies have shown, lead companies to increase the training of their workers, leading to higher productivity. and this actually tends to offset the higher costs of paying these workers.
So President Trump calls himself the great negotiator. Do you think he's been helpful in terms of negotiating the trade negotiations specifically?
Well, I personally think he's been rather a disaster in that realm. You know, it's I think he's he's very much opposed to these international trade agreements. I think renegotiating NAFTA, for example, as is going on now, may lead to cutbacks in trade with Mexico and Canada. Pulling out of the Trans-Pacific Agreement, I think, has been detrimental to the United States. Now, Japan and China have become big players, particularly in Asia. So I think he's really shooting himself in the foot and shooting our country in the foot.
What advice would you give the president?
Well, I would say that it's really important to not only maintain existing trade agreements, but to expand them, because that's the only way we're going to spur production in this country. I mean, right now, you see, we have these global value networks, so that if we want to produce solar energy, we need to import solar panels. And to increase the tariff on solar panels is going to hurt the domestic solar panel industry that provides power to households. So the president has to realize that this is a very interconnected world economy, and you can't simply cut off trade with one country or in one industry, because that will backfire.
Edward Wolff, economics professor at New York University, thank you so much for your time.
Thank you.